Leveraged ETFs are not meant to be held for the long term. In a previous video, I explained how leveraged ETFs work against you as an investor because of something called volatility decay. In that video, I gave a very simple example in which the underlying stock or ETF could have increased in value, but the leveraged ETF tracking it could have decreased during that same time. Now, in response to that video, a lot of people reached out with comments saying, well, this is not always true. For instance, if you look at QQQ, which tracks the performance of NASDAQ 100 index, and TQQQ, which is 3 times leveraged ETF tracking QQQ, you see that over the last 1 year, TQQQ has outperformed QQQ. Specifically, TQQQ has yielded about 60% return, whereas QQQ has yielded about 30%. And similarly, over the last 1 year, SPY, which tracks the S&P 500 index, has yielded around 20%, whereas SPXL, which is 3 times the leverage of S&P 500, has yielded about 40%. So yes, clearly, in these cases, the leveraged ETFs have outperformed the underlying index over the last 1 year. However, please understand that volatility decay is still working against you. Both TQQ and SPXL are 3 times the leverage of the underlying index, which means that you're taking on almost 3 times the risk of the underlying index. However, the returns that you are getting are not 3 times. Specifically, both TQQQ and SPXL have yielded only twice as much return of the underlying indices. So if you hold these leveraged ETFs over the long term, the risk-reward ratio is not in your favor, and it is because of volatility decay. Your risk increases almost linearly with leverage, but your returns do not. And the other thing to keep in mind is that the expense ratios of leveraged ETFs are considerably higher than the expense ratios or fees of the underlying index. So take QQQ, for example. The expense ratio on that is just less than 0.20%, whereas that of TQQQ is 0.95%, almost 5 times as much. So one more time, leveraged ETFs are not meant to be held for the long term. The risk-reward ratio is not in your favor, and on top of that, the returns that you're going to make net of fees are also not in your favor.